Okay. Hello, everyone, and welcome to the very first edition of UPF Nobel Lectures. As you may all know, the Swedish Royal Academy of Sciences announce every autumn their prestigious awards, the Nobel Prizes. That's why we came up with UPF Nobel Lectures, an annual event organized by the GEEP, where we will try to talk about the latest prize in economics. This year, the winners are Eugen Fama, Robert Shiller, and Peter Hansen. In other words, the Academy awarded the theory of the efficiency of financial markets as well as the theory of the inefficiency of financial markets. So today, we will try to disclosure and know a bit more about the financial markets. We will debate the irrationality of financial markets. So for this event, we are very pleased to present to you from FAMA's side, Dr. Xavier Freixas, a distinguished economist specialized in financial markets and the current head of the economics department here at UPF. In front of him, we will have defending the inefficient side presented by Shiller, Dr. Robin Hoggart, who is a former professor from University of Chicago and a laureate academic from behavioral economics. Finally, to conduct this passionate debate, we will have the collaboration of Dr. Jesus Gilbazo, who is the current director of the Finances Master at Barcelona Accredited School of Economics. Once said that, and just before we start with the event, I want to say just some thank yous. And don't worry, I'm going to try to be as quick as I can and not to bore you. So first of all, let me present ourselves. We are the organizers, the GEEP, the official organization of students of the Faculty of Economics here at Universitat Pompeu Fabra. And this group is coordinated by Miquel Petri, Victor Martinez, who is in the United States right now, and myself, Marc Raffanet. 2 years ago, Albert Barquet, a former student from Pompeu Fabra's University, passed us the baton of this organization that he built from scratch. Since then, we had been trying to make the best from it, organizing some conferences and activities related to the world of economics and business, nationally and internationally, from a critical and apolitical point of view. This is our goal, to make the economic thought become the key to understand this complex world where we all live. So my first thank you will go to him, to Albert Barquet, for this great initiative that one day he started, and now we are so happy to lead it. My second thank you is for all of you who are here, and because you are making the UPF bigger. You are showing that UPF students are interested in economics, are interested in knowing more. And the GEEP wouldn't make any sense without you, because our goal is to try to fill the gap between the theoretical courses and the real world, the questions that we all ask ourselves. So thank you for being here, and thank you for making this Faculty of Economics better every day, because this makes all of us better every day. And last but not least, I want to thank the Faculty of Economics who helped us to organize this event, because without their support, the GEEP wouldn't even exist and this conference wouldn't take place. And just to conclude, let me thank these three guys up here, because if they wouldn't accept our invitation, we will not be able to enjoy from this wonderful lesson. So thank you, Xavier Freixas, thank you, Jesus Gilbazo, and thank you, Robert Howard. And now I'm going to let Jesus to start with the conference. Thank you, everybody.
So good morning, everyone. Thanks a lot for the presentation. It's actually Javier, that's fine. It's a common mistake. Don't worry about it at all. Yeah. So I just wanted to say good morning, everyone, and also I would like to congratulate the organizers for putting together this nice event. It's really a pleasure to be talking, thinking, and discussing about these issues, and it's actually a privilege for me to be surrounded by these distinguished, renowned, and brilliant economists that we have in our department, and that we have to be very proud of being able to keep them in Barcelona and in Catalonia, despite all the hardships. So I think it would help us a lot to set up the framework for the debate if the two speakers today, Xavier and Robin, gave us their own view or a brief summary of what they think the contributions of this year's Nobel laureates, at least two of the three Nobel laureates of this year, what their contributions have been to the economic analysis, and particularly to our understanding of financial markets. So Xavier would like to start telling us a little bit about Eugene Fama's work.
Well, definitely there is one key thing in Eugene Fama's contribution, and that is the efficient market hypothesis. He somehow defined rigorously what was the efficient market hypothesis in terms of the information conveyed to the market, and then he tested and showed that this indeed was working. And the second one is the refinement of empirical approach to the stochastic processes of guiding the market, that is the so-called Fama French three factors models.
Thank you. Thanks a lot. Robin, could you please tell us your own view of Robert Shiller's work?
Okay. Shiller's work. I think the way to think about Shiller's work is the following. The first part of his work, when he questions the efficient market hypothesis, how did he do that? Because Fama had obviously come up with a lot of interesting insights showing that markets seem to be efficient in the sense you couldn't predict tomorrow's price from today's price for particular shares. Well, Schiller asked the following question: well, how do we evaluate a share, a stock? And he said, we evaluate a stock as the sum of the discounted cash flows of the stock out into the future. So if you think about a bunch of stocks and take the sum of the discounted cash flows, you have one way of evaluating the market. So let's post hoc go and see how would that stream of thing look across time. So you did a time series of expected discounted cash flows across time. How would that look across time? And he calculated it back from about 1970 or 80, I think, way back to 100 years ago. And he compared the flow across time of the expected discounted cash flows with the actual market volatility. And the idea is the following. The flow of the discounted flash flows across time essentially reflects an efficient market. That's what you'd do if the market was efficient. Let's compare that with the historical reality, which was a sort of another time series. And what he shows, if you look at the graphs, is the graphs of the expected discounted cash flows go like this, and the real data goes up and down like this. So his point was that basically the markets showed too much volatility to be efficient, because you could actually do the calculations of expected discounted cash flows in different kinds of ways and do sensitivity analysis. But the basic point was that there was far too much volatility in the market for the market to be efficient in this longer term perspective. So his point was, in that sense, something else must be going on. And one way of getting a good view of Schiller's work is read this book. It's called Animal Spirits, written by George Akerlof, also a Nobel Prize winner, and Schiller. And he talks about the different factors that could affect market prices. One is confidence or overconfidence. And he talks even about having a multiplier effect for confidence, which is kind of an interesting idea. Another is fairness. Issues of fairness come into these kinds of things very much. What's fair, what's not fair, and this goes up and down. A third one, which you'll appreciate, corruption and bad faith. And if you look at the history of the financial markets in the last 20 years, at least we know 20 years, there's been a lot of corruption, a lot of bad faith. And you saw when J.P. Morgan is paying $12 billion to the government in fines, claiming we're paying the fine, but we're not really guilty. Indicates the system was not working good. A fourth point is what he calls money illusion. They said that basically a lot of macroeconomic factors are driven by the fact that people don't understand money illusion. So when you come to do things like bargaining for wages in contracts, the people who are bargaining don't take account of don't understand money illusion. The difference between nominal and real rates of return are just not understood by most people in the common market. And finally, he talks about in this book too, that lots of times the way we understand the world is not by efficient market hypotheses, it's by stories and anecdotes. And that a lot of the movements so basically Schiller's major point is that a lot of economic factors, behavior, is driven by behaviors which are not in the economic models. There are stories, there are feelings, there are sentiments, there are emotions, which are done collectively, and these go up and down, and this forms part of what Keynes originally called animal spirits. And his claim is that you get these things. So, for example, two important points is that Schiller looks at the market, and he looks at basically at what is the return on the market compared to what you paid, and how is this changing across time. And he compares, like the price-earnings ratio across time. And when the price-earnings ratio gets very high, what's going to happen? The market's going to go down. When the price-earnings ratio for houses or real estate went off the wall, what happened? It went down. So basically, what Schiller's real contribution, I think, is to point out that you have these booms and busts because of animal spirits operating in the market. He's not saying that the efficient market hypothesis is wrong. It's just inadequate. It's incomplete.
So thanks a lot, Robin. Thanks a lot. Yeah, so I guess there are surely a different explanation for excess volatility. You mentioned excess volatility as being one apparent failure of the efficient market hypothesis. I guess there are also within the paradigm of rational investors and efficient market hypothesis, there are also explanations for excess volatility, such as time-varying discount rates. So again, like you said, that you very correctly exposed. So the price of an asset is the sum of the future expected cash flows of that asset generates for its holder, discounted by a discount rate, using a discount rate that takes into account the risk of that asset and investors' aggregate preferences. So I guess one explanation for excess volatility would be time-varying discount rates. I was wondering, whether you could say more about that, Xavier, whether you think that it's plausible that preferences change over time, or the perceived risk in the economy changes through time.
Definitely. Before that, since I'm wearing a tie, let me go on this style. On weekends, I don't wear ties. And continue with this idea. So you all agree that the value of an asset is the expected discounted cash flows duly discounted with a rate that takes into account the risk. Okay? Right? You all agree? So since I have the tie, I have also, that comes with the tie. Let's take, a big one, 20. How much is this worth? Any idea?
Now it's worth 20 euros.
Good. What is the coupon I have on this? Could you discount it on an infinite time basis and tell me what is the value of this? 0. Okay. So now you know where you are standing. Somewhere between the two theories. So Fama tells us that tomorrow's price is 20 because today's price is 20 and you cannot beat the market. The other idea is that the price is 0 and that we are facing a bubble. Because if tomorrow the government says, well, we are not repaying you anything on this, then this has no value. And with some probability, this might occur, right? Spain may one day decide to go out of euro and stop repaying anything out of this. Well, so you know where you stand. So going back to your question, indeed, it's the efficient market hypothesis is a very sophisticated hypothesis because it means that we have an idea of what the price tomorrow should be. So we have a model to say out of today's prices what tomorrow's prices should be, and then we test it. So there are 3 forms of the efficient market hypothesis that you may know: the weak form, the strong form and the semi-strong form. In the weak form, what we're saying, well, if you look at past prices, you're able to say what tomorrow's price will be. And if this is the case, you will say the market is weakly efficient. And basically, because you have some winners and losers and things like that, you can create portfolios, but basically you observe that indeed you cannot make a lot of money out of just observing past prices. You need more than that. The semi-strong form means that you cannot make money with public information. So, and this is a very interesting exercise. Look at the profit announcement of the firms. And can you make money out of observing what are the profits of the firm and then betting on it? The answer is no, it's too late. In fact, the profits are anticipated, and you observe when profits are above expectation, you observe that the price of the share goes up 2 days before, right? Because the information is already there in the market. The third form does not work. So public and private information, if you have private information, you will make money. And so this is observed, for instance, on firms' managers, right? So the bankers that sell their shares 5 years before the crisis had some information of their own. It was private information. And this, of course, means that the strong form of the efficient market does not work.
Okay. So do you think that the efficient market hypothesis is refuted by excess volatility, or do you think there is also a different explanation for that?
So the tests of the efficient market hypothesis are difficult because in order to test the efficient market hypothesis, you have to say, well, how do the price of shares behave? Is it a random walk? Is it a random walk where the volatility changes every day? And consequently, there is this difficulty. The more we learn about how prices react, the better we can test. And that's where the two contributions of FAMA get along one with the other. You know better about how to predict tomorrow's price depending on some random events, and then you test whether you can beat the market or not.
All right, thanks a lot. Let's go a little bit back to the basics. So the efficient market hypothesis is, and this is something that can be deducted from your words. It seems to be based on the idea that if there is an opportunity to make money, investors will try to take advantage of it. So it requires some form of sophistication on the part of investors. Robin, you are an expert in behavioral economics, and particularly you have performed a lot of research. You have done a lot of research on experiments where you test people's decision making. What does your research tell us about the rationality of investors, and what are the implications for the efficient market hypothesis?
Let me sort of start before I answer that question by telling a little story. One day when I was at the University of Chicago, I was getting beaten up by my finance colleagues and feeling very down because I felt basically, I wasn't being understood. And they were telling me things like, well, markets are really efficient. For example, if you walk down the street and you didn't find any, you wouldn't expect to find any money on the street, because if any money on the street, it would be gone by the time you got to it, which was kind of like this. And I was feeling very beat up by all this conversation. And I was walking down a street called 57th Street in Chicago one day, shortly afterwards. And I stopped because all of a sudden I saw in the street a $10 bill. And I it stopped me dead. And I said to myself, is this a dream or am I in real life? And I looked around the street where I was to see if anybody was looking at me. And I saw nobody was looking at me. So I bent down and picked up the $10 bill. And I felt very happy. I felt justified because it meant that basically, there was a God out there. And perhaps the efficient market hypothesis wasn't everything. So so I think actually that story illustrates that a lot goes on which can't necessarily be captured by the efficient market hypothesis. Lots of incidents happen, this kind of thing. But in terms of experiments have been done in what's called behavioral finance, I think that's what you really refer to, Javier. Behavioral finance is really a sort of a hodgepodge of different experiments people have done where they've taken very specific implications of efficient market type thinking and tested them. So, for example, one of the things they've looked at in behavioral finance is savings behavior. One of the most important investments anyone makes in their life is the investment they make in their savings, because, you know, when you're young, you probably don't think about it right now, but the money you're investing, saving now could make a big difference when you get to my age. But I'm too late to think about it. All right? So how do people go about saving money? And it turns out that in the Western world, saving rates have dropped at the individual level quite considerably. It's a real social problem because basically, if you guys don't save, the next generation may not be behind you to pay you, and you may not get any Social Security. So a really interesting problem is, how do people save? And Richard Thaler and other people have done some experiments when they've showed that basically people aren't saving enough, but there are ways in which you can actually induce people to save more. And this comes out of a model of individual decision-making originally developed by Daniel Kahneman and Amos Tversky, published in 1979, called prospect theory, which is an alternative theory of decision under risk. The key theory of decision under risk is expected utility theory. But one thing we know from lots of experiments is that expected utility theory doesn't predict everything. It's not bad. It's like a good first-order approximation to what people do, but there are various systematic biases people have, which due, for example, to what is called loss aversion and the effects of reference points. And we can come back and talk about that later if you like. But anyway, Thaler showed that it's possible actually to help people save more money by reframing the way they're asked to make their investments. So that's one big thing. Another similar thing is, I think, there's a big puzzle in finance called the equity premium puzzle. Equity premium puzzle is the notion that over the years, people who invest in equities earn a lot more money than people who invest in bonds. So basically, there's a premium for equity, and that shouldn't happen, because basically that shouldn't happen. There shouldn't be an equity premium puzzle. Why is that? Well, it turns out one of the explanations that come out from behavioral finance is that because when people make decisions to invest, they do it the short term in mind, and they look at that every 12 months, and they don't sort of do one decision and leave it a long time. So a lot of that. There's another interesting one called the disposition effect. The disposition effect is the notion that people, let's imagine that you've got two stocks. You own two stocks, A and B. A is doing quite well. Okay? B has lost some money. Which do you sell? Well, you're a good UPF student, you'll say B, right? But most of the time, people would sell A, because they don't want to actually incur the loss of B. Because if they actually sell B, they really incurred a loss. So they would rather sell A. And that's called the disposition effect. Now, it can be predicted by this theory called prospect theory. You play around with prospect theory, you come out with a prediction that's going to happen. And there have been extensive tests on the market with that. For example, a man called Odin got a whole set of data of investors from some little firm in California, and he showed that basically there's a huge disposition effect. Another aspect, I think, which is important also is overconfidence. It turns out there's a lot of evidence now that people tend to be overconfident, and this affects their trading behavior. And one of the biggest anomalies of investment behavior is excess trading. People trade too much. And men are worse than women. Okay, so what behavioral finance has come up with, and I think we may come back to this later, is a whole series of different little anomalies which don't make sense if you believe in the efficient market and a rational hypothesis. But the people are doing things systematically incorrectly and doing things incorrectly, which costs them money. It costs them money in overtrading. It costs them money being overconfident. It costs them money down the road in not investing in their savings properly.
So I guess at any point, any of you can answer and reply to each other. So.
Yeah, well, I would love to. So, at least So I fully agree that we might have limited rationality, that we have our own behavior, and even I can go further and say that even the average, because you can say the errors of one guy will make up for the errors of the other, and it compensates on average. No, I think on average we behave basically in the same way. But what I would like to emphasize is that we have if you take the efficient hypothesis to the extreme, then you don't understand the world we are in. Because then it means, why would you have a financial analyst? Why would Gene Fama had a firm to help people invest if it's all the same, right? If you cannot predict anything, what advice can you give people, right? So if you go to the extreme, that doesn't work. What it means is that there are a sufficient number of, let's say, information gatherers in the market that provide information and that have an impact on prices, that prices are such that the efficient market hypothesis works. And so, indeed, we have heterogeneity of behaviors, but if you have sufficient number of these, say, private equity funds, say, mutual funds, say, hedge funds, that work properly and that have access to sufficient funds, right? So this may make a difference between the behavior of the Bangladesh stock market and the New York Stock Exchange, right? It could be a difference that there are more informed or more people looking for information in one than in the other, indeed. So the extent to which the efficient market hypothesis is fulfilled might depend on the structures, no problem. But that the whole thing is that the fact that some of us behave in a not fully rational way is not a problem for the efficient market hypothesis, provided that you have sufficient number of people that invest in getting information and have a return out of this information. Private equity funds make money. Hedge funds, depends on the day, but private equity definitely do. So what do? They get information and they bet on this information. And you may remember the Abacus case from hedge fund Paulson that simply designed a security that was the worst possible CDOs, asset-backed securities, and this was the Abacus security, and it short sell it, and because they knew it was a very bad one, and Goldman Sachs decided that for $2 million it was worth it to do it, but then in the end his reputation loss was much larger than that. But it means that some people do have the information and bet on this, and that's some of our best colleagues have these firms to get information and trade on this information.
Okay, so if I can play devil's advocate here, so where were those information gatherers on the set of the crisis, right? What were they up to? So surely there were some people who realized that there was a huge bubble in the real estate, and that there were some securities whose price and whose value was linked to the evolution of the real estate that were clearly overpriced. But if they sold or if they short sold those assets, they didn't seem to have any impact on the prices, right? So what do you think about that?
Absolutely. You can say, well, there is something that doesn't work with the efficient market hypothesis, but I would say no. What doesn't work is something with the banks. And why I'm saying this? Because some empirical observation tell us that the banks that were more closely, where there was more investor activism, right? So that the shareholders were more active in pushing the bank in such and such direction, were those that had more losses, right? And so our view is that when you take a bank, if you take a lot of risk, heads you win, tails taxpayers pay. So, well, it's perfectly okay with the expected market, the efficient market hypothesis.
Okay, so Let me ask you. So you mentioned, Robin, a number of You mentioned, Robin, a number of biases that affect the human decision making, individuals' decision making, and how that can have an impact on the financial markets if information gatherers, if sharks, as they are sometimes called, are not paying attention or are not able to influence prices. So let me tell you my own impression of behavioral finance as a little bit as an outsider. So when you approach this field, you are overwhelmed. One feels at least I felt overwhelmed by the multiplicity of theories that try to explain human decision making. So let me just give you an example. If you go to Wikipedia, you will find there 92 different cognitive biases that affect decision making. You mentioned some of them, but there are lots and lots of them. Attentional bias, availability heuristic, base rate fallacy, belief bias, confirmation bias, framing effect, gambler's fallacy, impact bias, negativity bias, overconfidence effect, optimism bias, pessimism bias. So people are optimistic and pessimistic at the same time. And there are many, many others. So it seems to me that despite the plausibility, or if you want, despite all the evidence that we have against the efficient market hypothesis, right, still behavioral finance has a hard time trying to convince mainstream economists. And perhaps one of the reasons is that instead of having one single well-rounded theory on how people make decisions, they have 100 different theories. Right? So can you still call it a theory? Can you still call it a theory when it's just one theory tailor-made for one particular phenomenon?
Okay. There's no question that psychologists, the payoffs to psychologists and economists are quite different in the academic world. Economists get paid a lot of money or reputation, or getting reputation by showing even the craziest behavior is rational. Psychologists, on the other hand, go out of their way to show apparently rational behavior is crazy. And the benefits for the psychologists are basically finding a finding that's weird and putting your name on it, and that's kind of a medal. So there's a big, they're responding to the incentives of the profession at one level. On the other hand, it is a concern that I have and other people have that psychologists have not yet come up with a nice, simple theory of decision-making, like expect utility theory. The great thing about expect utility theory is really simple. And you can actually make it's operational, you can make predictions using it, and you can actually analyze things, what's the cost, what's the benefit, what's the utility. And human decision behavior is actually much more complex. And I think there's a reason, and I'll give you an example of it. I spent a lot of time working in one project once where we were trying to understand what we call order effects. Order effects are the following. I give you information in the order A, B, and you come up with opinion C. I give you the same information in the order BA, and you come up with opinion F. So basically, the opinion you come up with is affected by the order in which you receive the information, which shouldn't actually happen. Now, it turns out that if you actually try and look for order effects in the world, they're very, very pervasive and very complex and come up in all kinds of different orders, in different situations. But on the other hand, if you actually try and work it back and think, what is the psychological model that's driving that, the behavior? It turns out the underlying psychological model is very simple. So the people are actually quite simple. What's complex is the environment in which they interact. And what you observe is the interaction of this simple process in the complex environment. And so what you're getting when you look at human decision-making is the outcome of simple processes meeting complex environments and interacting in different kinds of ways. So I think one of the difficulties but on the other hand, is all you observe is the behavior. You don't actually observe the process. Okay? And what we need is a good model of the process. Now, what people are trying to do these days is get to the process, and there's all kinds of neuroscience methods and neuroimaging and things like that, which are trying to get to the underlying process. But it's very difficult to figure out what is the underlying process. Now, and at what level you should do it, what level you should model it at. One of the great things about economics, and I'll sound like I like economics, so I don't, but never mind. One of the great things about economics is it has a very simple model. And it says, don't worry about, and you go back and read Friedman, 1954, don't worry about what the assumptions are, just look at the predictions of the model. And if the predictions work, go with that model. And that's a nice, simple way of handling it. But actually, if you're trying to understand the complexity of life, you want to know about how emotions affect decisions, how misperceptions affect, so it's very complex. So I think one of the reasons you get this sort of multiplicity of effects is the complexity of the behavior. But the complexity of the behavior is a joint complexity of the individual on the one hand and the different situations which he or she is interacting on the other.
So thanks a lot, Robin. So it's true that the expected utility theory is very elegant and it's very well understood. And it's also the basis of all neoclassical models, both in finance and macroeconomics, and also microeconomics. But at the same time, it doesn't fare very well when you try to take the models to the data. A famous financial economist, Stephen Ross, has said that the data has yet to meet an asset pricing theory that it likes. In other words, we still haven't found an expected utility theory-based model for pricing financial assets that actually works. What's your opinion, Xavier, on this? Do you think that it's a failure of the failure of these models actually is, it's a symptom that markets are not efficient, or that's actually, good news for researchers because it means that there is a lot more work to be done?
Both, definitely. But indeed, so there are two things. One, we have not a good description of all the events in the markets. That is definitely the case. The basic model, expected utility, and even normality, we know it doesn't work. The normal distribution does not reflect the fat tails and so on. But the good news is that we have gone a long way from, say, the initial approach to the markets was to consider the risk of individual stocks. We have gone through matrices of covariances with Markovich, and then we have gone to sharp CAPM theory, and then from then we are now closer to either the three-factor Fama-French model or the arbitrage factors. And so somehow we are getting closer, and that's the good news, but we are not still there, definitely.
Yeah. So actually behavioral finance has also been accused of the same sin, not being very good at predicting individual decisions and not being, or individual behavior if you want, even if we don't understand the process that leads to that behavior, but being very bad at predicting aggregate outcomes, that is the outcome of the interaction of many individuals. Do you think we'll ever also get to that through behavioral finance?
One quick comment first. I'm not sure what we always mean by behavioral finance, so I'll just leave that on the side. The question is whether we can get from individual behavior to macro behavior, which is more of the question. I am basically spent my career studying psychology of decision-making at the individual level. I've done some work in groups. I have no idea how to handle macro behavior. For me, the big mystery of life is macroeconomics. Because basically I just don't see how it all fits together. I just think it's extraordinarily complex. I admire the people who actually make statements. I also think it's extraordinarily important, because understanding how all the macro effects work, I mean, just need to look at what's happened over the last 5-6 years. The macro things are incredibly important. And what's scary to me is, in Europe, for example, we don't seem to agree. The Germans say do this, the other people say do something else, we say this, etc. So, and yet these are extraordinarily important, big decisions. And I think that to be able to predict the macro level of the macroeconomy is a whole other. I'm just in awe of people who try and do that, because at the individual level it's already very difficult. Now you could argue that individual errors or things aggregate out, balance off in the average, but I don't think they do. I think there are interaction effects between individuals which are important, and the modeling is very difficult. So I think that's extraordinarily difficult. That's what I have to say. And I don't apologize for saying it's extraordinarily difficult, because cell biology is very difficult. We don't fully understand all the causes of cancer, for example, and other diseases. They're very complex, and we have the same problems handling those kinds of situations. So we're not in this. There are just things out there are complex.
Right. Thanks a lot. I'd like to ask you, Xavier, your opinion on something that one hears often, which is the fact that, or the idea that efficient market hypothesis is not only wrong, but actually the strong belief in the efficient market hypothesis is to blame for the recent financial markets, right? People who believe in the efficient market hypothesis think that markets take care of themselves. They can take care of, risky securities, of complexity, and so on. So there is no need for supervision. There is no need or limited role, at least, for supervision. What do you think about that, being an expert in banking and banking regulation?
Well, I think that it's indeed a problem, so that it's based on full rationality. And then when it comes to a banking crisis, what we observe is that households are excessively in debt. So they're in debt to the point that they presumably will not be able to repay their mortgage throughout their lives in some cases. And so there is something here about either rational behavior or information, in the sense that maybe people are sold products they don't fully understand, like the some subprime mortgages that are variable rate, and then in the first 2 years you have a teaser rate low, and then after that you have a high rate. Do people really understand this? Is there some kind of swindle on behalf of the seller of these products? So I think that consumer protection is at fault in the current crisis. Now it's difficult in our minds to go to put the limit where is consumer protection and where does a strict paternalism start, because you want to say, then you go to say, well, no, I want people not to eat fat. I want they all to eat vegetables, and then where difficult to put the limit somewhere. And so I think that there is this, that it was too easy for banks to go to extreme positions in terms of the risk they were taking. I think that the institutional setup was such that also a number of financial products were bought by mutual funds and by pension funds. Nothing against this, but sometimes these are remunerated as a percentage of the portfolio, and as a consequence, the incentive to gather information are quite different from private equity. Private equity, you bet on the information you get. Here, you get a 2% return on the portfolio. So if you go for a AAA, then it's okay. And then you go to rating agencies, and rating agencies wanted to give AAA because then customers are very happy and they will come back, right? And so when you take the whole picture together with this separated institution, each one is maximizing its profit, but together they are doing a pretty bad job at getting right information and conveying this information to the market. So overall, I think the problem is that when you have some type of incentives for the different agents, so banks that quite often will be rescued with taxpayer money, rating agencies that are making 50% of their revenues out of rating complex securitized securities, CDOs, and so on. And pension mutual funds that say, well, if it's a AAA, it's okay and I won't invest more into that. When you have these together, this creates a very bad incentive for the whole society to get good quality information. So that is more difficult to go to the efficient allocation. Right?
I think there's another factor, actually, which fits into what you're thinking, and that is the individual remuneration of bankers. I think that the culture of bonuses, which means basically bankers get paid by bonuses, they don't worry about their monthly thing, they wait for what's going to get in December, it becomes very important. And therefore that sets up a culture within the corporation to try and create new products in which people can get more bonuses on. And people were walking away with absolutely bonuses which are just unbelievably big compared to what they were earning even 10, 20 years ago. And I think that the cultural thing, this thing feeding into each other, is huge. I remember going to, in Berlin a few years ago, I remember speaking with the head of the Deutsche Bank at the time, Ackermann. And he was talking about bonuses in his bank and how he couldn't afford not to pay his people bonuses, because if they didn't pay them bonuses, they would go elsewhere. So it's not just a question of one bank doing it, all the banks are doing it. And I think this huge culture of bonuses has a lot of blame to make at the individual level, because I'm not interested in inventing these kind of financial instruments that Javier is talking about unless I'm going to get a bonus. But if I get a bonus to making them, I'm going to make lots of them. And it's going to be more fun, right? It's very easy. In 2 hours, 2 days, 3 days, I can make up a new instrument. And at the end of the year, I get $20 million more. And I think that when those kinds of monies are held in front of people, they know for short periods of time they can work very hard, get an awful lot of money. I think that has a culture which means that I'm here today but gone tomorrow, and that's exactly the kind of culture we don't want to have if we're going to keep stability in the situation. So I wouldn't blame just the poor people who didn't understand they were buying bad mortgages.
But going back to the question of the debate, if markets were efficient, the incentives of the wrong incentives of bankers would be something that wouldn't matter, right? Because shareholders wouldn't like the managers of the banks that they own, making wrong decisions or simply being paid too much. Credit rating agencies wouldn't be important if markets were efficient, right? Actually, we wouldn't need credit rating agencies in the first place, right? Because investors know what the true value of debt is and other instruments is. So basically, from listening to you, the two of you, I believe that none of you believes in efficient market hypothesis.
I think one of the big problems in the corporate world these days is actually the fact that shareholders don't actually have a larger say in the companies. I think somehow or other that it's a kind of a myth to think that shareholders are actually overseeing all these decisions. They're coming once a year to perhaps to a meeting, but so I just don't think that works. There's something not working well in the shareholder model.
Yes, I agree. So theoretically, shareholders are represented by the board of directors. But in fact, the board of directors is quite often chosen by the CEO, and so quite often it's a friendly board. So the representation is quite limited. The mandate of the board is to maximize the value of shareholders' wealth, right? So the mandate goes in the right direction. But here again, when you talk about banks, you are not maximizing the value of the bank. That would be the value of debt plus equity. You don't care about debt. You rather care just about the equity part. If the Modigliani-Müller theorem is correct, for those of you who are familiar, then it's the same. But when you talk about banks, it's not correct. We know that you have insurance protection, deposit insurance and the like, and that banks are supported sometimes by public funds. Therefore, it doesn't work.
Interesting. So I'm going to try to allocate some time for questions from the audience. But before I do that, there's some interesting final questions that I'd like to ask the two of you. So in 2010, Nobel laureate Eugene Fama famously said in an interview, and I quote, "I don't know what a credit bubble means. I don't even know what a bubble means. These words have become popular. I don't think they have any meaning." In fact, he seems to believe that a recession caused the collapse of the real estate market and not the other way around. Do you agree with this this way of thinking? And in other words, why do you think that mainstream academic economists are so reluctant to accept the failure of the efficient market hypothesis and perhaps of the neoclassical paradigm?
Yeah, I mean, Gene Farmer says basically that the sort of just every now and then when there's a lot of uncertainty, there's excess volatility. And so basically that doesn't contradict efficient market hypothesis. It just says that we're going through a period of uncertainty. When there's uncertainty, there's a lot of volatility. So I don't think Gene's looking at the world correctly, because there are bubbles. They occur quite frequently, and I think according to Schiller, they're actually inevitable in the way the system works. So I think that we have to understand how bubbles work, because they're an important part of the macroeconomic cycle. Because if we understood them better, we'd understand more of the cycles better.
So I fully agree. Bubbles, in my view, bubbles exist. So the quote of Eugene Fama may be related to what we call a bubble. A bubble exists only if we all agree on what are the fundamentals. But once we disagree on what the fundamentals are, we cannot define a bubble. That's how I interpret the sentence, the quote you mentioned. Now, I think bubbles exist, and I think that it's impossible to identify a bubble in the stock market, but it's possible to identify a bubble in the real estate market, and that definitely central banks and regulators should be more attentive to bubbles in the real estate market. Yes, because this is a predictor of systemic crisis, and basically we know it.
And two final questions. The first one is, how do you see the future? Do you think that these apparently contradictory views will converge at some point? Or do you think that maybe a third way of looking at financial markets and the economy in general, such as evolutionary economics, for instance, will find its way into mainstream economic thought and will replace the current paradigms?
I'm reminded of a story told by Enrico Fermi. Do you know who Enrico Fermi was? Enrico Fermi was an Italian physicist. He was the first person to explode a nuclear device. He did it in a gymnasium at the University of Chicago, doing his calculations with a slide rule. Anyway, Enrico Fermi was asked, how can you get your theories accepted? And he said, go to a lot of funerals. In other words, his model was that basically people had theories, and theories go through generations. And after a while, theories are going to die because the people who are supporting them are dying. And so the only way to get your theory accepted is to stay alive and go to a lot of funerals.
Indeed, what we call truth is something that is quite short-lived. And then it's all scientific paradigms live and then die. And every time we have a better perception of how the Earth moves, we now know that it's not the sun that goes around the Earth, but that we just turn around. And maybe the same thing, we have to accept the same thing about our financial markets, that we learn, and then we go towards something that represents the equilibrium behavior of prices, that takes into account a degree of irrationality, that takes into account the incentive of every agent, and takes into account the information gatherers and financial analysts that are also there.
And one final question. So there's obviously a lot of work for researchers of of today and researchers of the future. There's some students here from the master in finance. Some of them, I'm sure, will be doing a PhD in the future. So you guys have a lot of things to do. But we're also teachers, and some of us are also teachers, right? I always have this personal problem of not knowing exactly how much time to allocate in my asset pricing class, my financial economics class, to behavioral finance, and how much to allocate to the standard theories. Do you have any advice for me?
Do what you want.
Well, I think it's very important for people to be acquainted with what risk is. And so I would tend to say that it's important to teach that, well, we don't know exactly what risk is, but that this is related to correlations, to systemic risk versus idiosyncratic risk, and that there are different ways to consider this, how volatility evolves, and all this should be part of our common culture. Now, once we have the common culture, we may start saying, well, there is this price anomaly, there is this other price anomaly, how do we understand this? And this will contribute to our understanding of the markets. But I would tend to say risk is what we can convey, and it's not easy. Spontaneously, probabilities are not easy to grasp, and Robin knows much better than I do all these examples about 3 doors, and you always have these contests and so on and so forth that tell us that probability is not something that you intuitively grasp. You have to be trained, understand, and so on, and there are lots of anecdotes and problems that I always miss.
I would just add one word to that, 2 words actually. Not just risk, but perception of risk. How people perceive risk, I think, is the important thing.
Very nice. So thanks a lot. I think we have plenty of time for questions from the audience. So please.
Someone has a question. Yes. In order to give the microphone.
I will speak loudly without microphone.
No, so. But the thing is that this session is recorded, so.
Okay. As far as I understand, rational means that we can elaborate some laws and some laws of, and using these laws we can predict something. Irrational, it means that we don't have any laws, and the system can behave in any way. But how can we study irrational if there are no any kind of laws and there are no any rules?
First of all, I disagree with your take. I think you have to distinguish between irrational and systemic. I can do things systematically. Rational is relative to the rational model. Your behavior relative to a set of principles or axioms. You can violate the axioms in a consistent way. And that would be called irrational behavior, according to the rationalists. So it's not really a question of rational versus irrational behavior being crazy behavior. Because irrational behavior means behavior that's not rational. It doesn't mean necessarily that it's not sensible, and perhaps even not functional. So rational has a in economics, rational is defined typically within the terms of being consistent with expected utility theory. Okay? But or if you take a savage view, which is subjective expected utility theory, you can have probabilities which may be totally crazy. But if people are consistent with those probabilities, they're behaving rationally. Though other people might think they're behaving crazily. So it's not a question of one is being irrational means irrational is crazy. Is that clear?
Yeah.
Another important aspect is that basically rationality usually assumes rationality of means, not rationality of ends, of purposes. And we have no theory for rationality of purposes. But the purposes are very important because they're objectives. Where do your objectives come from? That's very important. And are those rational or irrational? For example, a psychopath may be thought of by society as having crazy objectives. But the psychopath could actually be very rational in the way he or she carries out his or her crimes. Okay? So it's not as simple as just saying one is the opposite of the other. I'm sorry, that's my interpretation. But thanks for the question. It's a good question.
I agree with that. And simply, I wanted to point out as well that when you say disorder and crazy, the rational theory tell us that what we observe is a random behavior. So that this randomness is not crazy at all. Is what is expected from the efficient market hypothesis is to observe random behavior of the price around some expected equilibrium that is given by some model.
Everything depends on point of from which we estimate. Yeah, so of the point how we look at it. Yeah,
you have to estimate a model. Yeah.
Small question, short question to Professor Hogan. Then you took into account bubbles to support your idea, and in the same year as Animal Spirits was published, Nouriel Rubini, a professor of New York, published a book that I read in Italian. I think that crisis is not end or something like that. I don't know the translation about the crisis. And he clearly described how we can predict bubbles. And Paul Krugman definitely supported this idea. So if we are able, what I'm asking you is, if we are able to predict bubbles, how could you think that markets are so irrational?
Well, let's go back to what we mean by rational, irrational for the moment again. Rational, we mean basically in accordance with the theory. Irrational, not in accordance with the theory. Okay, doesn't mean it's not as crazy in some sense. But I would argue that we can predict bubbles up to a point. We can also create bubbles. For example, there's a whole area of experimental economics deals with bubbles. And I have a student right now who's creating bubbles. If you ever go to he's not singing songs with it, but he's creating bubbles. And he can create bubbles by running these experiments. They're able to understand what is the pattern of prices that leads to bubbles in some cases and not bubbles in other cases. But people are behaving individually rationally. But the trouble is you get into a collective situation, and when you get into a collective situation, then you're going to get this funny kind of behavior. It gets back to what I was saying earlier about, and I'm not being very clear to you, I know, but it gets back to what I was saying earlier about I can understand the individual rationality of the individual person in a bubble situation. What's difficult for me to understand fully is the total of the way the whole thing works together. But bubbles, what I think is more important, a question to ask is how can we prevent bubbles happening? And that gets back to some of the issues that Xavier raised about are we going to be policemen? Are we going to be, how can we handle that? And so on and so forth. That's the more difficult situation. I think we understand how bubbles happen. The question is how can you stop them? And how can you actually police them? And how could you help people, should you be helping people get out of them? And a lot of people would argue that you shouldn't be helping them. Okay?
Yeah, there is to answer, there is a theory of rational bubbles. So you may think that in equilibrium, okay, you know there is a bubble, right? But you don't know when the bubble will burst. So you may think of a situation in equilibrium, you have with 50% probability, you have the price that will double. With 50%, you have zero. Then for a neutral risk-neutral person will break even, right? So this means that if you have a bubble, there is someone that is betting that the bubble will continue, And this one is buying the bubble, and someone that is betting that the bubble will burst, and this one is selling the bubble. So there are two agents in the market, and the question is, we should give them better information to avoid the worst out of the resulting equilibrium that can lead to a crisis. But more than that, should we prevent people from buying houses, selling houses? It seems difficult.
Okay, I have a question for Mr. Freixas. You mentioned that prices of the stocks change before the annual reports are basically published, but I could not agree with that. I mean, sometimes you see that prices change after the annual report is published, and then they start changing. I mean, it happened with Google this year when you saw like 10% jump. That it crossed $1,000 price, and it happened after the report was published. And also, I don't know, for a lot of stocks. I mean, if you follow Apple, it's always the same, and with a lot of companies, when they publish their reports, if the reports meet the speculators or the investors' expectations, the price remains the same or goes up. If they are not met, then it goes down. And you can see that after the reports, like for a couple of days even.
Yeah. So let me be more precise on my statement. So these are called event studies. So you take all the reports and you have all the firms, you somehow put them together and look at what happens 1 week before, 5 days before, and so on and so forth, on the cumulative abnormal return. Because you have a model that predicts, say, that over these 15 days, the expected return is flat, maybe, because interest rates will not change much on 15 days. And so you have this cumulative. So if the public information is available to the market only, and so it's only the day when it's issued, the efficient market hypothesis will tell you will observe a jump, and then that's it, right? So, but in fact, what I was trying to convey was that it's even more than that. That financial analysts, I don't know how, are able to get information and to have the price starting to increase or to decrease 3 days, 2 days, 1 day before, and then you observe the report is released, and you observe possibly an additional jump.
And then for Mr. Hogarth, you've mentioned, I don't know if I got this right, that considering your theory, that price of bonds, I mean return on bonds and equity should be the same, but I didn't quite get it. You were talking at the beginning.
I talked something called the equity premium puzzle,
okay.
which is the notion that for some reason or other, there's lots of theories about it now, the returns on equities are much bigger than the returns on bonds.
Yeah, exactly.
And people, if that's the case, why don't people hold more equities and less bonds? That's the point. That's the equity premium puzzle, right?
Exactly. So the difference in expected returns is too large. Basically, it's too large. It cannot be explained by risk.
Okay.
Sorry.
Okay. Thank you.
For reasonable expected utility,
Exactly.
it doesn't work.
Exactly.
Okay, I missed that. Okay.
Yeah, sorry.
Thank you.
Behind in the elephant room.
At the back.
Yeah, we briefly talked about the banking culture, and I just wanted to ask about the revenue-driven banking culture. I just wanted to ask, what could we implement to change the incentives of the bankers? Could we maybe get more women into banking as they're more risk-averse?
I think it's a good question how you change the culture of banking. It's not clear to me do it. I think you'd have to do it by legislation to start off with. I think there's some really interesting movements right now around the world. I actually don't like bankers or CEOs. And I was very interested the other day by Switzerland, because Switzerland had a vote as to whether CEO pay should be kept down. Now, I'm glad to say, despite my feelings about CEOs, that didn't pass. because I don't like the idea of the law coming in and doing it. But on the other hand, I was glad that socially people were saying CEOs are getting too much. So I think it's a question of developing social norms to try and handle these issues. I don't think this can really be well handled by legislation. Whether you may need a little bit of legislation just to get things started, but there are some things happening in some countries. So, for example, now we're getting more countries have more women on boards than before. You have to have so many percentage of women on your boards. That's, I think, probably a good thing in the short term. But it's really a question of the social culture. How can we put it into our social culture, these things?
There is some change also in regulation, in financial regulation that is going on. In particular, there is emphasis on the clawback clauses, so that you get the bonuses, but if the products, the financial products, then generate losses, or you get part of your bonus, but if it doesn't work, then you don't get all of your bonus, and this will lead theoretically to the right to better behavior still.
I would consider myself as the audience, and I would like to ask you a question. I think it was yesterday in Fox Business, Alan Greenspan talked and said that in the financial markets, a lot of things can go wrong, but this culture that now is raising from the 2008 crisis, that the financial markets are a bubble and are the problem of the crisis, is not correct and is a wrong way of seeing everything. And in addition, with this, I would just look the time that I think was last month. It published an issue within the cover, people saying Wall Street is back. So after all this huge crisis that we just lived, and we are in probably, what are we learning, and what are the changes that the financial markets are going to experiment if people such as Alan Greenspan, who was the FED chairman during a lot of time and is one of the guys that made the regulations for the financial markets before this crisis, before Ben Bernanke took the place, where the financial markets are going to go, and we are going to solve some problems that may avoid new crises.
Well, I'm a bit of a pessimist on that. I think that there is a trend that when you are confronted with a crisis, you say, we'll change the regulation. Then you change the regulation, and for sure you will avoid the same crisis. The last crisis, you will avoid it for sure. Now, then things go back to normal, and you say, well, all this regulation is not really needed, right? And so you discard this regulation, that regulation, more the regulation, and then you go to a next crisis. So my view is rather pessimistic, I'm sorry.
So I guess we have run out of time, unless one last quick question, perhaps.
Okay, it's a question for who wants to answer. What do you think that it's the paper or the role exactly of that kind of non-professional investors, as we said, for example, that ones that have the information late or operate with this kind of information, or that ones that, for example, are selling the stock that it's making profits and not the other one? What do you think that it's the paper of that person in the market? If it's important, or they are just a little piece of the cake?
Can I answer two questions on this one? First of all, I think at the individual level, you are a fish in the ocean. You make no difference. But it makes a difference. What happens in the market makes a difference to you. And probably the best thing you can do is become a passive investor. Put your money in a fund which is indexed to the market, and forget about it.
Yeah,
and that way, I think you'll be much better off than people who try and actively participate in the market.
but I count this like a professional ones because they have money, but they are giving the money to professionals. I mean,
Well, you go to a fund that like Vanguard, put your money in Vanguard, and just put it on the indexes, and that's the best you can do, and don't look at it. And the last thing you should do is look at the financial pages every day. That's the worst thing you can do. Because if you do that, you're going to always want to change, and you're better off not doing it. The trouble is, individuals are very sensitive to changes. And unfortunately, we have a culture now whereby you pick up the news in the evening, or you tell in the television news, people are telling you what happened on the market today. Oh, the market went down today, it wasn't feeling well, et cetera, et cetera. And this is all stories, noise. You should forget about it. So basically, save your money, forget about it, and keep living.
Let me just add up something to that. Investment advice, make sure that you pay the lowest minimum fee on your index fund.
Exactly.
So I think we're done. So please let's thank the speakers and the organizers for a fantastic discussion.